To become rich in 5 years, I need to save and invest $300K per year. My current profession only pays me $200K per year, so I'm quitting. In this video, I'm sharing the exact 5-step plan I'm using to bridge that gap and hit my number. When you want to make big changes in your life, I think it is important to be specific. After doing some homework on personal finance, investment strategies, entrepreneurship, there was one concept that stood out for me personally: the concept of financial independence. Financial independence can be defined as the point at which your passive income equals or exceeds your burn rate. I believe the term burn rate originally came from the world of venture capital, where startups burn cash while becoming real businesses. Let me give you some examples of financial independence. I'll use the extreme examples. And the first one is my mom. She's retired, she's on the pension, and she's financially independent. Her income is not very high, but her expenses are quite low as well. So technically, she's financially independent and lives a pretty happy life. Let's take another extreme example, Austin Matthews, who is the professional hockey player, well known in Canada. He probably earns $15 million a year, but he needs to play hockey to actually earn that income. I don't know what his burn rate is. Most professional athletes lead very lavish lifestyles. But I would say if he invests all of the money that he receives, he'll probably be financially independent. If not now, definitely in the future. So again, these are two examples that fit the same formula. But let's go back to my case. Let's be more specific. And I need to answer 3 questions. Where am I now? Where do I want to go? And how do I get there? So let's start with the first one. Where am I now? Right now, my burn rate is around 10K per month, which comes to 120K per year. Now, this is so big because of the housing. I have a mortgage, I have a house that I own. So approximately half of that burn rate is the housing. I do have some passive income. I rent out part of my house, so I have $24,000 a year as a passive income. Plus I have about $4,000 a year of passive income from the investments that I have. So all in all, I have 28K of passive income, but I do need 120. So where do I want to go? 120 minus 28 is 92. And so to get that additional 92K per year of passive income at, let's say, 7% annual return, let's be modest, not too much, not too little. So 92K at 7% AR, I need $1.3 million. Let's round it up, $1.5 million, because by the time you get there, there's inflation, it's going to take some time. So I basically need $1.5 million to get there. Who doesn't? So how do I get there? I think I have 5, maybe 10 years in me where I can work efficiently and I have enough energy to hustle. To get to $1.5 million in 5 years, I will need to save and invest $300K per year. And there are 5 steps that I need to take to get there. And step number 1 is probably the hardest. Step number 1 is generate strong income. But before we get to the details on that, I wanted to talk about a common misconception about how to get rich. I think many people think that you get rich by investing to hit big and get high income. I think the reality is the other way around. First, you get the high income and then regularly invest what you can. Then, when your investment capital becomes large enough, 100K approximately, and that's the secret number that I hear, you start leveraging your capital through compounding interest. and then you get even more dollars, right, to your bank. But your income still has to remain strong. So eventually you become rich by combining two things: your income that is leveraged by your skills, tech that you have, or personal brand, and your investment capital. Investment capital that leverages time value of money. So I think it's really important to establish that at the start. And for those of you who are not familiar with that time value of money, I think it's a very basic concept in personal finance. And it says that a dollar you have today is more valuable than a dollar you might receive a year from now, because the dollar you have today could be earning interest for that entire year. I earn roughly 200K per year. After taxes and expenses, I could probably say 50K per year at most. But for that, everything has to line up perfectly. But we've already established that I need 300K, right? So really, I need to earn another 600K per year on top of the 200K that I have. Now you would say, well, why 600K? Because the arithmetic is very simple. 800K gross comes out to 400K net after you subtract all the taxes. Minus 120K burn rate, you're getting to 280K I can save and invest. Now we're getting somewhere. Unfortunately, my 9-to-5 job doesn't cut it. I need to change my profession and do something else. If I want to hit that number, this is what I need to do. And now we came to the most important part of my plan on how to get rich. And that is step 2. Use leverage. To become more wealthy, I need more leverage. I need to leverage what I have or will have to get better results. And as an example of leverage, just think of the simplest thing. Have you ever seen a tree stump? Try to remove that thing with your bare hands. It's impossible to do. But if you have a steel bar that you can dig into the ground underneath the stump and then leverage it, then you can be more successful at removing this thing. Leverage is even more important than the financial independence formula itself. In fact, leverage is the name of the game on how to get rich. There are 4 levels of leverage: labor, media, capital, and technology. Let's go through each one from the easiest to the most difficult. So labor leverage is the simplest form. You start by working for somebody, then eventually you can hire somebody and you can leverage their labor towards your benefits. So that's one way of leveraging labor. Media is another way when we're talking about product scaling without extra resources. For example, internet or social media. So if you have a product or a service that you try to sell, you can go door to door and try to sell it. But if you use media like internet and social media, you can reach many more people, thousands of people, maybe even millions of people by going on the internet. There's also financial leverage, where you leverage capital. Mortgage is one of the good examples of leveraging capital. So you take a mortgage and you buy an asset which hopefully appreciates in time, and that's how you leverage. You can do the same thing with venture capital when you use venture capital to grow startup businesses. You can leverage stock market investments. So that's the example of financial leverage. The hardest one is the technology, because it's so hard to build a unique technology. But if you do have it, it's a one-time cost and unlimited users. For example, you build a software or you build Facebook and you do it one time, and then there's virtually unlimited number of users you can, well, it is limited, but it's exponential in terms of your investment into growing the number of people on your platform. So the basic idea of leverage is it has to work while you sleep. And that's how you get rich. So that's step number 2. Which brings me to step number 3, Big changes require time. So you need emergency fund while you're going through the transition. There's no quick fixes. It's a journey. Personal finance or wealth consultants recommend to save 3 to 6 months worth of your essential costs of living, like housing, food, transportation. So in my case, the absolute minimum is $6,000 per month. Multiply that by 6 months, you get to $36,000 that you need as an emergency fund. And I think there's 3 options of how to get that number if you don't already have it. So first thing is you have income, and then every paycheck you basically allocate some money towards the emergency fund. And you can put it in the tax-free savings account where you don't pay taxes on capital gains, and it's easily accessible. You can take it out when you need it. In Canada, it's called TFSA. I think in US, it's called IRA. In UK, it's ISA, etc. Different countries have different names for it, but it's essentially a tax-free savings account. The second way is severance or compensation. So if you have a career, if you work for your employer for a long time, if you're highly skilled and trained, so if your company ever decides to let you go, or if you decide that you want to be let go, then severance and compensation is a good option. I mean, think about it. You can have 3, 6, 8, up to 12 months of severance paid to you in your salary. And that would be really great to transition, because you can essentially focus on your new career or your plan or business plan to pursue your interests. There's another way, which is the last resort you can use, which is borrowing against the assets that you already have. So for example, if you own a house, you can take out a line of credit against your home, the so-called home equity line of credit. And then the interest rate on that is usually lower than the market rates. Now, it's not the ideal way to do it, borrowing to finance your future endeavors, but it's an option. So let's talk about the step 4. Step 4 is also quite simple. You need to cut the costs. And this is the step that affects the burn rate part of the formula. So I took the Excel sheet, I listed all my costs, and I sorted them from highest to lowest. And my objective is very simple. I need to cut the costs I don't really need. The largest cost that I have is my house, the mortgage that I pay, the interest that I pay. Unfortunately, there's nothing I can do about it now. I need to hold on to it, because if I exit early, I need to pay penalties. And right now the market is such that if you sell your house, you probably take a loss, which is something you don't want to do. So I'm going to stick with the house for now. No alimony or marriage liabilities, which is great. My vehicle is paid off. I don't have credit card debt. I mean, I do, but I really can pay it off monthly. It's not a problem for me. I have some debt on my line of credit, which I know I need to pay off. It's low interest, but I must pay it off, and I know that. So that's in the making already. I don't use cable. I don't watch TV. So why have it? It's almost $100 a month, which comes to $1,200 a year. And what is it that television can tell me something I can't do by Googling or using ChatGPT? I really don't think it's a useful thing to have cable and watch television right now. The next one is even bigger, Netflix and sports channels. And the biggest thing is not really the cost of it. It's not just the money, but the time that you spend watching all of this. Imagine how much time you can save to learn something instead. Learn about AI, learn about financing, learn about entrepreneurship. How much time you spend on all of this. And, it's a never-ending carousel. Hockey starts, the football is already underway, then the basketball. And then once this is all over in the summer, then the baseball starts. It never ends. So I've decided to cut it out and save some time to spend on more important things, more valuable things. You can save on other costs that you're paying. For example, I've just learned a year ago that I have electric water heater in my house that I'm renting from the utility companies. The amount itself is not huge, but when I approached them and I said, look, what if I just buy a new gas heated water tank? Wouldn't that make more sense? And of course, it does make more sense. So they kind of budged and they gave me some discounts. It's a small number, but the point is you can negotiate this type of things with your service providers, be it the internet, insurance. And the last thing I'm going to say about the cost is I'm going to keep the caffeine, because you hear on the YouTube, oh, you spend $5 a day at the Starbucks, and that adds up to hundreds of dollars per year, and then you can invest in an S&P 500, yada, yada, yada. Okay, relax. I'm keeping the caffeine. Which brings me to the last point of my plan, is that you need to invest what you earn. And really, I think this is just about the discipline. And it's actually quite simple if you follow the rules. So you must invest a portion of your paycheck every time you receive it. The best thing is to set up automatic transfer or set amount to your investment platform, just like it works with the employer. Because, for example, my employer pays to pension. It actually matches my contribution. And that way it forces me to participate in the program because it's free money. So they basically withdraw that money from my paycheck every time. And then the money is there. I don't even know how much is there. Well, I do now, but in the past I wasn't paying attention to this. I kind of gave up on that money right away. Essentially, it's a forced form of saving. So if the employer does that for you, why can't you do it for yourself? Just what is the number, the share of your paycheck that needs to be invested, and then just set it up yourself, right? So I think it's pretty easy to do. The other question that comes up all the time is how much to invest. And there are different suggestions. There's different numbers and different ratios. So 65, 20, 15, 70, 20, 10, 50, 30, 20. They're all different versions of the same thing. So the first number is a percent of your paycheck for daily living expenses. The second number is the percent of your paycheck that you can use for fun and pleasure on a regular basis. And the last number is the one that we're actually interested in. It's the percent of your paycheck that you need to allocate for long-term investments. The extreme case is 20%. I think that's hard to do for an average person, but I think 5 to 10% is not painful and it's actually doable. And the last thing I want to talk about today is the classic rules of investment. If you follow those rules, and these are well-known rules, I just put them all together. So this is for safe investing. And if you follow it, you should be fine, especially if you have time for long-term investments. So first things first, you need to invest what you earn and forget about it for 3, 5, 10 years, whatever your time period is. So we just talked about, right? Second thing is you need to invest in a risk-balanced portfolio with expected returns sufficient to your long-term goals. So that's self-explanatory. So you need to weigh the risk and balance. You need to understand what expected returns you're looking at. Do you want 3%, 5%, 17%, 10%? You need to agree on that with yourself and then just stick with that strategy. Don't try to time the market. That's not a good idea, even for professional investors. Don't pick the individual stocks. Also not a good idea, even for professional investors, let alone for simple people like us, like me. Be prepared for the future to be different from your current expectations. That's another important one. Things happen all the time. We went through many crises in the past, 2000 and 2008, and they're talking about AI bubble right now. So anything can happen. Be aware of your fees and costs for your investments, because sometimes you buy something and you say, oh, wait a minute, what is that charge? Well, almost every investment comes with some sort of charge, some sort of fee. So you need to research that beforehand and then you shop around and pick the ones that you want to go with. There's a pros and cons to all those fees and different financial instruments. Don't be too sure of anything. Again, anything can happen in financial markets. Things change. Wars are started, economic crises, recessions, COVID, anything can happen. So keep that in mind as you invest. And finally, diversify. That's a basic rule. You need to make sure that your portfolio is balanced. You have bonds, you have stock, and one goes up, the other one goes down, and they go in circles, but you're diversified. It's the best way to protect yourself. Now, all those rules are for average person. So if you do have 20, 30 years, you just follow that and you'll be fine. Now, unfortunately, I don't have that, so I need to think about other things. So here's my take on it. If you invest in S&P 500, on average, it will give you 7 to 10% return, which is good. However, average monetary inflation, the so-called M2, for fiat currencies like US dollars or Canadian dollars or British pounds, they're all the same. They're all fiat currencies. So the average monetary inflation is also 7%. If you invest in S&P 500, you're not really gaining anything because the monetary inflation kills your investment. You're basically staying at the same level. There are other companies like Magnificent Seven, which you can invest in, and they will give you an average of 15%. Now, these are Google, Amazon, Apple, Tesla, Facebook, Microsoft, Nvidia. We all hear about them. They're always in the news, and they're really darlings of the Wall Street, and they earn more than 7%. So that's great. But the rules we just talked about, they say don't pick the individual stocks because it can get wiped out. So you be the judge. Do you want to be safe and earn your 7% with the index funds, or do you want to go and risk with Tesla or Nvidia? It's it's your decision. Now, there are other investments like crypto that could be even more profitable if you have higher risk tolerance. Crypto has more volatility. It's a well-known fact, but it's another topic altogether. So again, personally, I don't have 20, 30 years of runway. I'm looking at 5 years to get rich. And so I will be exploring AI, crypto, and other tech. That would be my choice. If you enjoy the content, please click the like and subscribe buttons. More detail about all of this in my next video next week.